Picture this. You sign up for a service. It's recommended by someone you trust. It sounds professional, sophisticated. The fee seems reasonable, small even, just a single percentage point. You authorize the payments. They're automatic, silent. You barely notice them coming out. You continue with your life. You work, you save, you plan for a future that feels distant and abstract. You check your statements occasionally, see the steady progress, and feel reassured that you're doing the right thing, that you're on track. The small fee? It's just the cost of doing business, the price of guidance, the toll for a smoothened road. You never really question it. Why would you? It's only 1%. Hi, I'm Alex. I explain how money actually works in real life, not just what's popular or sounds easy. I use simple stories and clear ideas to teach patient, long-term planning and smart habits that help build wealth over time. Before we begin, I want to be clear. This is for educational and entertainment purposes. It's about exploring ideas, sharing frameworks, not giving you personal financial advice. Today, we're going to talk about one of the most accepted yet most consequential numbers in the world of long-term investing. It's a number that sounds like a rounding error, but acts like a gravitational force. It's the management fee. The hidden problem is not that these fees exist. The problem is that we fundamentally misunderstand their true cost. We look at them linearly, as a simple, flat cost, 1% per year. But in the world of compounding returns, costs don't work like a flat tax. They work like a reverse compound interest. They don't just take a little from you each year, they take a little from every future year of your potential growth. When you pay a 1% annual fee on an investment portfolio, you are not just giving up 1% of your money, you are giving up 1% of your entire future. Every dollar that fee consumes is a dollar that can no longer earn returns for you for the next 10, 20, or 30 years. That lost growth has its own lost growth, and on and on. The true cost is invisible, deferred, and staggering. It creates a false sense of progress. You see your account balance rising and think your strategy is working, and it might be, but you cannot see the parallel universe version of your portfolio, the one where that fee didn't exist. That shadow portfolio, growing unimpeded, is racing ahead, and the gap between you and it widens with every passing year. You are in a race where your opponent gets a head start, and you're agreeing to carry a weight that gets heavier over time. So let's make this concept concrete. The core idea is this. In investing, you don't pay fees with your money, you pay them with your time. Let's use a simple example. Imagine two farmers, Emma and Sam. They own adjacent identical plots of land. Each receives 100 identical apple saplings to plant, representing your investment capital. Emma plants all 100 of her saplings. She tends to them herself. Sam also plants 100 saplings, but he hires a professional orchard manager. The manager's fee is 1% of the harvest, paid in apples, every single year. Year 1, both orchards grow. The harvest comes. Each tree produces 10 apples, a 10% return. Emma's field, 100 trees times 10 apples equals 1,000 apples. She keeps all 1,000. She uses some to live on and replants the rest. Sam's field, 100 trees times 10 apples equals 1,000 apples. He pays the manager 1%, or 10 apples. He has 990 apples. He replants 990 seeds. The difference seems trivial, just 10 apples. But here is where the story bends. The next spring, trees grow from the replanted seeds. Emma's new trees come from 1,000 apples. Sam's new trees come from 990 apples. He starts year 2 with fewer trees, not just fewer apples, fewer productive assets. That 1% fee wasn't taken from the harvest after growth was calculated. It was taken from the capital before it could grow. It reduces the very base upon which all future compounding happens. Fast forward 30 years, Emma's orchard is vast, a thriving forest of apple trees. Sam's orchard is also large and successful, but it is noticeably, measurably smaller.
When they finally decide to stop planting and live off the harvest, Emma has a significantly larger perpetual source of food. The manager's 1% fee didn't cost Sam 1% of his orchard. It cost him a large percentage of his final, mature orchard. The fee didn't eat apples. It ate trees. It ate the very things that produced apples. Translate this to finance. The 1% annual fee doesn't just take 1% of your balance. It takes 1% of your productive capital every year. It shrinks the engine of your growth. Over decades, this results in the loss of not 30% of your money, 1% times 30 years, but potentially 40, 50, or more of what your portfolio could have been. You are paying with the most valuable currency you have, your future compounded returns.
So we have our example. A fee isn't a fee, it's a claim on your future harvest. But to really feel this, we need to do one more thing. We need to introduce the single most powerful force in finance, the force that makes this 1% so dangerous. That force is time. Think of time not as a calendar, but as a magnifying lens. It doesn't just pass, it amplifies. It amplifies the power of your savings to grow through compounding. But by the same unbreakable mathematical law, it also amplifies the damage of a small repeated cost. Let's follow the numbers. Meet Maya and Ben. They're both 35 years old. They each inherit $100,000 to invest for retirement at age 70. They both achieved the same average annual return of 7% before any fees. Maya invests in a simple, low-cost portfolio. Her total fees 0.10% per year. Ben uses a popular full-service managed portfolio. His total fees 1.00% per year. That's a difference of 0.90%. It sounds like nothing. Year 1. Maya's return, 7% minus 0.10% fee equals 6.9% net gain. Her balance grows to $106,900. Ben's return, 7% minus 1.00% fee equals 6.0% net gain. His balance grows to $106,000. Difference, $900. Ben thinks worth it for the service. Age 45, 10 years in. Maya, approximately $196,000. Ben, approximately $179,000. Difference, $17,000. Ben's portfolio is about 9% smaller. He might not even notice, buried in statements. Age 55, 20 years in. Maya, approximately $384,000. Ben, approximately $321,000. The difference, $63,000. Ben's portfolio is now 16% smaller. The gap is the size of a new car. The critical visualization, the shadow portfolio. Let's show what Ben's $100,000 would have grown to at the full 7% return with no fees. This is his shadow. By age 55, the shadow portfolio is worth approximately $387,000. Ben's actual portfolio is worth $321,000. The 1% fee has already cost Ben $66,000 of his potential wealth, not in fees paid, but in growth never realized. Age 70, the final picture. Maya's balance, $1,083,000. Ben's balance, $811,000. The difference, $272,000. Ben paid a total of roughly $145,000 in fees over 35 years, but the opportunity cost, the growth those fees prevented, was $272,000. For every $1 in direct fees Ben paid, he lost nearly $2 in future wealth. Understanding the problem is the first step. The second step is building a strategy that protects your future returns. This isn't about avoiding advice or guidance. It's about being ruthlessly efficient with the costs you incur to get it. What to stop doing. 1. Stop ignoring the expense ratio. This is the most important number on any fund or account statement. It is the annual fee expressed as a percentage that you pay for the fund's management. Find it. Know it.
2. Stop conflating cost with value or complexity with sophistication. A higher fee does not guarantee higher returns. In fact, study after study shows the opposite is generally true over the long term. A simple, low-cost strategy is not amateurish, it is efficient. What to automate and implement. 1. The fee audit. Once per year, conduct a simple fee audit. For every investment account, 401k, IRA, brokerage, list the funds you own and their expense ratios. Calculate the weighted average fee of your entire portfolio. Your goal is to get this number below 0.20%. This is your primary mission. 2. The low-cost core. Structure your portfolio around a core of ultra-low-cost index funds or ETFs. These are funds designed to track the entire market, like a total stock market index or total bond market index. Because they are automated and not actively managed, their fees are extremely low, often between 0.03% and 0.10%. They are the engine of your growth. Keep it simple. One fund for U.S. stocks, one for international stocks, one for bonds. That's often all you need. 3. The advice unbundling. If you want or need professional financial advice, consider unbundling it from investment management. You can pay a fee-only fiduciary advisor by the hour or as a flat retainer for a comprehensive plan. Then you can implement that plan yourself using low-cost funds. You pay for the advice directly, transparently, and you keep your investment costs near zero. This separates the cost of thinking from the cost of owning. What to track? Track one key metric, your portfolio's weighted average expense ratio. That is your true tax on growth. Watch this number go down over time as you simplify and optimize. This is a more important number to track than any quarterly return. What to ignore completely. 1. Past performance of high-fee funds. It is meaningless for predicting future returns and is often the marketing hook used to justify high costs. 2. The fear that doing it yourself is too complex. The fundamentals of building a low-cost, diversified portfolio are simpler than most people are led to believe. The complexity is often a feature of high-fee products, not a necessity. 3. Any sales pitch that suggests beating the market is a routine service you can buy. It is not. What you can buy with certainty is lower costs, and lower costs are the one reliable predictor of keeping more of the market's returns for yourself.
We began with a simple, seemingly innocuous invoice for 1%. We traced its path over a lifetime and saw how it transforms from a small line item into a major financial force, not by what it takes, but by what it prevents from ever being born. The real price of financial advice isn't found on a statement. It's found in the gap between the future you have and the future you could have had. It's measured in time lost, in options foreclosed, in security diminished. Your wealth-building journey is a long-term partnership with the market. Your job is not to outsmart the market, but to partner with it as efficiently as possible. Every percentage point in fee you save is not a point of return added, it is a point of friction removed. It is pure, retained energy that continues to compound in your favor, for your benefit, across all the years to come. You don't have to become an expert investor. You simply have to become a vigilant owner. Protect your compound interest like it is the most valuable crop you will ever grow, because it is. Tend to the soil of your portfolio by minimizing costs and let time and the market's growth do the hard work. Thank you for watching. I'm Alex. Until next time.